Ladies and gentlemen, welcome back to Street Smart Secrets, your home for practical wealth strategies, smart investing principles, and the financial truths the wealthy understand, but most people are never taught. Today's episode is one that could completely change the way you see money, borrowing, and financial freedom. Most of us grow up hearing one thing about debt: avoid it at all costs. We are told debt is bad, debt is dangerous, and debt is the fastest road to financial struggle. Parents warn against it, schools rarely explain it properly, and many people spend their entire lives trying to stay as far away from debt as possible. But here's the surprising truth. The wealthy, especially high net worth individuals in America, don't just tolerate debt, they strategically use it. In fact, some of the richest people in the world have built empires using borrowed money. They understand something most people never learn. Debt itself is not the enemy. Misused debt is. Think of debt like fire. When controlled, fire cooks your food, warms your home, and improves your life. But when left unmanaged, it destroys everything in its path. Debt works the exact same way. Used wisely, it can help you buy appreciating assets, scale businesses, preserve cash flow, and create generational wealth. Used carelessly, it can trap you in endless payments, financial stress, and a cycle of living paycheck to paycheck. Wealthy investors know the critical difference between good debt and bad debt. Good debt is tied to assets that grow in value, like real estate, businesses, or investment portfolios. Bad debt is tied to consumption, like credit cards, luxury spending, and personal loans that offer no return. One builds wealth, the other quietly destroys it. And in today's episode, we're going to break down exactly how debt can either be your greatest financial ally or your worst financial enemy. Because once you understand how the rich use debt to get richer, you'll never look at borrowing the same way again. 1. Buy, borrow, die principle. One of the most powerful wealth-building strategies used by wealthy Americans is something called the buy, borrow, die principle. And while the name may sound dramatic, the concept is surprisingly simple and incredibly effective. It works because the rich understand one important truth. Selling assets too early can be expensive, but borrowing against them can keep wealth growing. Let's say you're in your 30s, 40s, or even 50s, and over time you've built a strong investment portfolio, maybe stocks, rental properties, or even ownership in a business. Imagine one of those investments, like stock, is now worth $500,000 and has grown significantly over the years. If you decide to sell it, you could trigger a large capital gains tax bill, sometimes $50,000 or more depending on your situation. That's money leaving your pocket immediately. Now here's where wealthy people think differently. Instead of selling the asset, they borrow against it. They take out a short-term loan using that stock or investment as collateral. Why? Because borrowed money is not considered taxable income. So instead of losing $50,000 to taxes, they may only pay around $8,000 in interest on a short-term loan at 6.5%. That's a huge difference. Even better, the original asset remains untouched and continues to grow in value over time. The stock keeps appreciating, dividends may still come in, and real estate may continue generating rental income. In simple terms, they keep the goose that lays the golden eggs instead of selling the goose for quick cash. This strategy becomes even more powerful when that borrowed money is used wisely, such as investing in another income-producing asset, expanding a business, or funding another opportunity that creates even more returns. This is where debt becomes a tool for multiplication, not destruction. For people between 20 and 50, this lesson is critical because these are the prime wealth-building years. Younger adults in their 20s and 30s can use this mindset to focus on acquiring appreciating assets early, while those in their 40s and 50s can use it to protect and preserve wealth without unnecessary tax losses. And the final piece of the strategy is the die part. When wealthy individuals pass away, their heirs often receive those assets with what is called a stepped-up basis. That means the capital gains taxes on the appreciation can disappear entirely. The family inherits wealth with less tax burden, allowing money to move across generations more efficiently. That is why buy, borrow, die is not just a tax strategy, it is a long-term wealth machine. 2. Mortgages, residential and investment. Mortgages are often seen as simple tools for buying a home, but for wealthy individuals, they are much more than that. They are one of the smartest forms of strategic debt. A mortgage is not just about having a place to live. It is about using leverage to control a valuable asset while keeping your cash available for other investments. In 2025 and 2026, mortgage rates are averaging around 6 to 7%, and while many people see that as expensive, high net worth individuals often see it as an opportunity. Why? Because mortgage interest on up to $750,000 of qualified home debt can often be tax deductible, which reduces the true cost of borrowing. That means the actual financial burden is often lower than it appears on paper. Let's make this relatable. Imagine you're in your 30s or 40s and you have enough savings to buy a home outright for $600,000. Many people think paying cash is always the smartest move, but wealthy investors often choose the opposite. They take a mortgage instead. Why? Because tying up all your cash in one property limits your financial flexibility. By putting down a portion and financing the rest, they preserve liquidity, cash that can be invested elsewhere in stocks, businesses, or additional real estate that may generate even higher returns. Instead of one asset, they position themselves to control multiple wealth-building opportunities at once. The strategy becomes even stronger with investment properties. Rental real estate creates a powerful combination of cash flow, appreciation, and tax advantages. The rental income helps cover the mortgage payments, while the property itself may increase in value over time. On top of that, mortgage interest for investment properties is generally deductible as a business expense, making the numbers even more attractive. This is why so many wealthy Americans build long-term wealth through rental properties. They let tenants help pay down the debt while the asset grows in value. Private banks take this even further by offering jumbo mortgages and interest-only loan options for high-net-worth clients. These products allow wealthy borrowers to make smaller monthly payments up front, preserving even more liquidity for investing elsewhere. For people between 20 and 50, this lesson is powerful. A mortgage should not just be viewed as a monthly bill, but as a strategic financial tool. Used wisely, it can help you build equity, preserve cash flow, and accelerate wealth creation. The key is understanding that smart debt is not about borrowing to consume. It is about borrowing to acquire appreciating assets that work for you over time. 3. Home equity lines of credit, HELOCs. Think of a HELOC, a home equity line of credit, as a financial Swiss Army knife, flexible, powerful, and incredibly useful when handled wisely. Instead of letting the value built up in your home just sit there untouched, a HELOC allows you to borrow against your home's equity and turn that value into accessible capital. In 2025 and 2026, HELOC rates are often around prime plus 0.5%, which usually places them in the 7 to 8% range. For many wealthy individuals, this makes it a much cheaper option than relying on high-interest personal loans or credit cards. But here's the important part. The value of a HELOC depends entirely on how the money is used. Let's make it practical. Imagine you're in your late 30s or 40s, and your home has appreciated significantly over the years. Maybe you bought it for $300,000, and now it's worth $500,000. That built-up equity is a hidden source of financial power. Instead of selling the house or draining your savings, a HELOC gives you access to part of that equity while you continue owning the property. Wealthy borrowers understand this and use it strategically. They might use it to renovate the kitchen, add a rental unit, finish a basement apartment, or expand the property in a way that increases its value and future income potential. In these cases, the debt is working for them, not against them. Another smart use is bridging temporary cash flow gaps. For example, a business owner may need short-term capital before a major client payment arrives, or an investor may want quick access to funds for a time-sensitive opportunity. A HELOC provides that flexibility without forcing them to sell investments or trigger unnecessary taxes. And if the money is used specifically for qualified home improvements, the interest may even be tax-deductible, making the true cost of borrowing even lower. But here's where many people go wrong. They treat a HELOC like free money. Using it for vacations, designer purchases, luxury spending, or lifestyle upgrades that produce no return can quickly turn a smart tool into a financial trap. The wealthy avoid this mistake because they understand a simple rule: borrow for assets, not for appearances. For adults between 20 and 50, this lesson is critical. A HELOC can either become a stepping stone to greater wealth or a shortcut to deeper debt. The difference lies in discipline. Used wisely, it is one of the most flexible and lower-cost ways to access capital and build long-term financial strength. Number 4, margin loans and securities-backed lines. Margin loans and securities-backed lines of credit, often called SBLOCs, are where Wall Street strategy meets personal wealth building. This is one of the most powerful tools wealthy investors use to create liquidity without selling their investments. Instead of cashing out stocks, bonds, or ETFs and triggering capital gains taxes, they borrow against the value of their portfolio. In simple terms, their investments become collateral for a loan. This allows them to access cash while their assets remain invested and continue growing. For many high net worth individuals, this is a smarter move than selling because it protects long-term compounding while avoiding unnecessary tax bills. Let's make this relatable. Imagine you're in your 40s and over the years you've built a strong investment portfolio worth $800,000. Suddenly, a major opportunity appears, maybe a rental property, a business investment, or a chance to expand your company. You need quick access to $200,000. Most people would think the only option is to sell part of their stock portfolio, pay capital gains taxes, and reduce their future growth. But wealthy investors often do something different. They use a margin loan or an SBLOC. Depending on the lender, they may be able to borrow up to 50% or more of their portfolio's value, often at rates as low as 6 to 7% for larger accounts. That means they unlock cash without interrupting the growth of the original investment. Another major advantage is tax efficiency. Interest paid on these loans can often be deducted as investment interest, which lowers the true borrowing cost even further. This makes portfolio-backed lending especially attractive for people who want to preserve wealth while still having access to capital. It supports the same philosophy behind the buy, borrow, die strategy. Don't sell the asset if you can borrow against it more efficiently. But this strategy comes with serious responsibility. The biggest danger is something called a margin call. If the market drops sharply and the value of your portfolio falls, the lender may demand additional cash or force the sale of your assets to protect the loan. This can be devastating if the investor is over-leveraged or emotionally unprepared. That is why this strategy works best for disciplined investors, not reckless ones. Wealth is not just about what you earn, but how intelligently you use what you already own. Margin loans and securities-backed lines can be powerful wealth-building tools when used to fund productive opportunities, but like all smart debt, they require planning, discipline, and a clear purpose. Used wisely, they allow investors to let their money keep working while opening new doors for growth. Number 5, business and commercial loans. For entrepreneurs and business-minded individuals, debt is not a burden, it is fuel for growth. Business and commercial loans are some of the most valuable forms of debt because they are designed to create income, expand opportunities, and build long-term wealth. Unlike consumer debt, which usually finances things that lose value, business debt is used to fund assets and activities that can generate profit. In 2025 and 2026, traditional business loans often come with interest rates between 6 and 10%. And one major advantage is that the interest is generally fully deductible as a business expense. This makes the true cost of borrowing much lower and often far more attractive than giving away ownership through equity financing. Let's make this practical. Imagine you're in your 30s or 40s and you own a growing business, a restaurant, logistics company, consulting firm, e-commerce brand, or even a real estate business. You have an opportunity to expand, maybe opening a second location, buying better equipment, hiring a stronger team, or acquiring a smaller competitor. You need capital, but using all your personal savings could leave you financially exposed. This is where smart debt comes in. Instead of draining your cash reserves, you use a business loan to fund growth while keeping your liquidity intact. If your borrowing cost is 8%, but the expansion helps your business generate 20% more profit, the debt is no longer an expense, it becomes a wealth-building machine. Wealthy business owners understand this principle deeply. They use debt strategically to scale operations faster than cash alone would allow. Some even move beyond traditional bank loans into private credit markets, which have grown into a $3 trillion industry. These markets offer additional financing options like mezzanine debt, private lending, and leveraged buyout structures. Mezzanine financing, for example, may carry higher interest rates between 8 and 15% or more, but it can provide the flexibility needed for major acquisitions or aggressive expansion. Private equity firms use this approach all the time to buy companies and multiply returns. Of course, higher returns come with higher risk. If business growth slows or cash flow weakens, debt can quickly become pressure instead of progress. That is why successful entrepreneurs treat borrowing with strategy, not emotion. For adults between 20 and 50, this lesson is powerful. The goal is not to avoid debt completely, but to use debt that produces income and builds assets. Business loans can turn a small operation into a thriving enterprise when managed wisely. In the hands of the disciplined, debt becomes more than financing. It becomes an accelerator of financial freedom. 6. Art, collectibles, and specialty collateral. For most people, debt is connected to homes, cars, or businesses, but at the highest levels of wealth, debt becomes something far more creative and unconventional. One of the most fascinating examples is the use of art, collectibles, and specialty assets as collateral. Ultra-wealthy individuals don't just own valuable items like fine art, rare watches, jewelry, classic cars, or even private aircraft. They often use them as financial instruments. In other words, these assets are not just stored wealth, they can be turned into immediate liquidity without ever being sold. Let's make this relatable. Imagine someone in their 40s or 50s who has spent years building a valuable collection, maybe a piece of fine art, a rare luxury watch, or even a vintage car that has appreciated significantly over time. Under normal circumstances, if they needed cash, they would have to sell the asset. But selling comes with a problem. Once it's gone forever. And in many cases, selling may also trigger taxes or mean losing something emotionally significant. Wealthy individuals take a different approach. Instead of selling, they borrow against the asset. Here's how it works. A financial institution evaluates the value of the item, say a painting by a well-known artist or a luxury aircraft, and provides a loan based on that value. The owner keeps possession of the asset while accessing cash for other opportunities. This is like turning a Picasso painting into a line of credit. It allows wealth to remain intact while still becoming useful in real time. Interest rates on these types of loans are typically higher, often above 10%, because the assets are less liquid and harder to value compared to stocks or real estate. But for the wealthy, the cost is often acceptable because the goal is not cheap borrowing, it is flexibility and liquidity without liquidation. This strategy is especially useful for individuals who hold unique, non-traditional assets. For example, an entrepreneur might use a private jet as collateral to secure funding for a business expansion. A collector might borrow against a rare watch collection to invest in another opportunity. In each case, the asset continues to exist, potentially appreciate in value, and remain part of the owner's legacy while also unlocking capital in the present. However, this is a high-level strategy that requires discipline and financial awareness. Because if repayment fails, these prized possessions can be seized. That is why it is typically used by individuals who already have strong cash flow and multiple layers of wealth. The wealthy don't fear debt. They respect it. They use tax-deductible asset-backed loans to grow wealth while avoiding high-interest consumer debt that destroys it. They understand that rates, leverage, and risk are all part of the game. Debt magnifies both gains and losses, so the question isn't whether debt is good or bad, it's whether you're using it strategically or recklessly. Debt isn't inherently bad, it's about how you use it. Wealthy individuals borrow against appreciating, income-generating assets, often with tax advantages to compound returns. Bad debt, high interest, non-deductible, consumption-driven, erodes wealth. The difference between financial freedom and financial ruin often comes down to whether debt is used as a lever or a liability. So here's the paradox at the heart of everything we've discussed today. Debt is not inherently good or bad, it is simply power. And like all forms of power, it depends entirely on how it is used. In the hands of the wealthy, debt becomes a lever for expansion, a tool for acceleration, and a bridge to greater opportunities. They don't fear borrowing, they structure it. They don't rush to sell assets, they borrow against them. And instead of letting money sit idle, they reinvest it, allowing compounding to do the heavy lifting over time. This is how fortunes are quietly built in the background, while most people are focused only on earning income. But on the other side of the spectrum, bad debt tells a very different story. It is the debt of consumption without return, of lifestyle without leverage, of payments without progress. And for millions of people, it creates a financial trap, one where income comes in, but freedom never gets closer. The difference between these two paths is not luck. It is not even income. It is understanding. Because debt, when misunderstood, becomes a chain, but when mastered, it becomes a ladder. So the real question is not whether debt exists in your life, because it already does in many forms. The real question is, how are you using it? Are you treating debt like fire, carefully controlling it to build warmth, security, and growth? Or are you letting it spread unchecked, slowly burning away your financial future without you even noticing? If this opened your eyes, make sure you hit that like button, subscribe to Street Smart Secrets for more real-world financial breakdowns, and stay plugged in for content that most people never hear in school. And before you go, drop a comment below and tell me, do you think debt is a tool or a trap? Let's get the conversation started.